Let's talk about the LIC IPO. Around 22 crore shares are on offer at a price band of 902 to 949 rupees per share. The size of the IPO and the value have both been brought lower, and that has apparently made it much more attractive, the value, that is. Let's understand what this means though, and let's take a deeper look at the business of the corporation. Aditya Shah, who is Chief Investment Officer of GST Investments, is joining me now. Thank you so much, Aditya, for taking the time. Appreciate it. Let's start with the business, though. I'm sure a lot of my viewers are trying to understand how Life Insurance Corporation works. Obviously, this is among the largest life insurers in the world with a massive network and a huge number of agents. But for the layperson, how would you explain the scale of the business that they would be buying into?
Good evening, Alex. Basic simple terminology. Life Insurance Corporation sells savings plan as well as insurance plan. So for example, if you want insurance of your life and want some income at the age of 55, 60, so life insurance would do that for you and give you some guaranteed income after the age of 60, 65, or whenever you choose to expire your policy that is there. On the scale side of it, it holds about 64% market share in the country, and about it manages about 45 lakh crores of AUM. That's about 2.5 times of the whole mutual fund industry that is there. So the scale is wow for the company. The scale is very, very big for the company, and it will continue to dominate the life insurance space in this country that is there. And it is losing market share to the private insurers. However, it will be very, very difficult after 50% for any private insurer to stump LIC that is there. So broadly, it's a very big company that is there. It manages about 45 lakh crores of AUM. The second largest life insurer manages, it is about 5.5 times of the second largest insurer that is there. So on all scales, it is the largest insurer. It has got about 14 lakh crore distributors that is there. And on the asset side of it as well, it is a very big market maker that is there. So as such, there's no problem as such with the company. And given the scale, I feel that it's a very good company to buy into.
I want to understand the potential going forward, because this is obviously something that you have to bear in mind. Sure, the scale is massive. It is at multiples, as you said, of its nearest peer. It has a huge network, a legacy of assets. But I want to understand the potential for this business. And I'm sure that you've looked at the RHP, you've looked at the industry as a whole. Could you tell my viewers what the potential for Life Insurance Corporation is?
First of all, Alex, let's talk about the life insurance sector. It's the sunrise sector of the Indian economy, as 70% of India's population is about 30 to 40 years of age. All of them will require life insurance that is there. The sector growth over the next 10 years is projected to be anywhere between 15 to 20%. That's the first point that is there. The second point that is there is on the margin side, we have seen LIC's margin. So how do we analyze the insurance sector is we look at how much money does the corporation make on every insurance policy that it sells. On LIC, the margins are at 9%, whereas on all private life insurers, the margins are at about 25 to 30% that is there. On the new business growth that is there, LIC's growth is far slower than all the other private life insurers that are there. On the persistency ratios as well, it means how many people are renewing their policies. It is also lower than all the other insurers. However, the flip side is because these ratios are lower, the government has brought down the valuation, and the valuation is very, very competitive. As you said, it is competitive to all the life insurers, not only in India, but across the world. It trades at about 1.1 times embedded value, which is a fantastic valuation at which the government is bringing the IPO. So all the cons that the company really has, that the margins are at 9%, the persistency ratios are lower, and the online evolution of the company is also slower. If the management is able to turn all of this in the next 2 to 3 years, which the management is really promising, there could be a very big valuation re-rating on the company as well as growth re-rating on the company, and it could prove to be a very good stock in the insurance sector. However, we need to track all of these metrics as the stock gets listed and the management makes progress. So all the weaknesses of the company can turn out to be the strength of the company over the next 4 or 5 years, as the management is really promising. So we need to watch how the business performs.
Glad that you pointed out the valuation, because I want to talk about that as well. One is the price band. You're talking about 902 to 949. The 1.1 times embedded value would be at the top of that price band, right? But you have policy holders and you have retail participants that are getting this IPO at a discount. So it's more advantageous to them, right? Having said that, wouldn't you say that it is difficult to estimate how the growth is going to be based on those very points, the cons that you mentioned, that one must take this with a bit of a pinch of salt? And if there is a re-rating, help us understand what this 1.1 times of embedded value means. If you talk about the global peers, if you talk about the domestic peers, if that re-rating takes place, what is the potential for growth of value of LIC?
Let me give you an example. HDFC Life had similar metrics when it got listed back in 2017. After 2017, the business completely changed, where their margins moved up from 15% to about 29%, and the market re-rated the stock from about 1 time embedded value to about 3.5 to 4 times embedded value, where it trades at today. Let me first explain what is embedded value. Embedded value is the present value of all the profits that are going to accrue to the company over the next 10, 15, 20, 25 years until infinity, that is there, right? So today, LIC's valuation, because of its poor margins that are there, are at about 1.1 times embedded value. HDFC Life, which is the third player in the sector, trades at about 4 times embedded value. SBI Life, which is the second player in the sector, trades at about 2.5 times embedded value. So if LIC is able to turn around its business, this embedded value could go to the multiple of 2, 2.5, 3, which could mean a real good upside from here on that is there. However, we have seen that government companies are really slow to change. The management in their roadshows have said that they are going to focus more and more on the protection plan, which are very profitable, and they are going to move from 1% to 10% on the protection plan. If this happens over the next 3 years, the margins will automatically move to 15, 16%, that is there, and the valuation will re-rate. And if the valuation does re-rate after the set time horizon that the government will not sell for 1 year, the massive dilution that the government will do after 1 year, all of that will get absorbed. So in my view, the weaknesses of LIC are an opportunity for all retail investors. The thesis of investment will be invest little bit right now, monitor the growth of the company that is there. If the company starts to grow fantastically well, start to invest more. However, right now, there's no need to go overboard. However, you should not also avoid the IPO. You should get some bit of allocation that is there inside the portfolio.
I want to talk about some of the aspects separately, but I want to first talk about the performance metrics that you just pointed out. Now, life insurance, I think, is something that a lot of people are familiar with on this program as well. This is the Money Show, the ET Money Show. We speak about the need to have a life insurance policy, right? The use case has been explained. But at the same time, I don't think that a lot of people understand how this business works. So if you could explain, assume that somebody who is watching this program, Aditya, is managing to get allocation in the IPO, is managing to hold shares of LIC. What are the metrics that they should watch on a quarterly basis, on an annual basis, to understand that the business that they have bought is doing well? You've mentioned persistency ratio, you've mentioned a few more things. How do they know that the company is doing well?
Okay, let me give you 4 or 5 metrics which an average retail investor can easily track. Point number 1 is, how is the new business premium growing? How is the company selling new policies that are there? LIC's new business growth has been in the range of 8 to 9%. However, the management is saying that they will be able to scale it up to double-digit growth that is there. That's the first point that is there. The second point that is there is what we call value of new business margins. It is similar to a profit margin in an FMCG company. It means how much profit does a insurer make on every 100 rupee of premium it makes. LIC's margins are at 9%. All other insurers, private insurers, margins range between 25 and 30%. So what you have to really see over the next 2 to 3 years, are these margins really improving? And all that data is available in the presentation that the company really gives. The third point that you need to really monitor are the persistency ratios. What does persistency ratio mean? It means how many people are trying to renew their policy and how many people are trying to lapse their policy. Today, LIC's persistency ratio is at about 60% broadly on an average. This will improve over the next 2 to 3 years to 65% and eventually to 70%. So that's the third metric that you need to really monitor. And the fourth and the most important metric, as we look at the P ratio in an FMCG company or any other company, we have to look at the embedded value. Embedded value is a valuation metric for all insurance companies that are there, and you have to track how is the embedded value growing year on year, that is there. If it grows at 10 to 12% year on year, it is fantastic and it is excellent, that is there. So these are the four metrics that you need to take care of: value of new business margins, embedded value, persistency ratio, and new business premium. How are these growing? If they are continue to improve over the next 1.5, 2 years, you have a good stock which will compound at a fantastic rate, that is there. If any of these ratios do not improve and we have a hangover of government dilution, that is there, then there can be a problem. That's why my advice to retail investor is go slow and steady, don't go overboard on the IPO, and monitor the progress of the company.
I want to talk about the mix also, because if you're talking about the types of policies, you mentioned that there are a few different types of policies. I'm sure people are also aware of these different types of policies. What is the most advantageous to have? What is the most profitable? And what is the mix currently? You mentioned that the company is looking to change that mix. How easy or difficult, Aditya, is it for them to change this mix?
Okay, let me give you the profit margins of each of these policies. Pure pay protection plans are profitable anywhere between 50 to 70%. Savings plan, as you say, savings plan where savings as well as insurance is mixed, are profitable anywhere between 10 to 15%, that is there. And annuity business, LIC is a very big player in the annuity business, that is there. It is profitable anywhere between 20 to 30%, that is there. Now, 98% of LIC's portfolio is in the savings plan, where the profitability is anywhere between 10 to 15%. And that's a key drag on the LIC portfolio that is there. If you look at all private insurers, nearly about 25 to 30% of their profitability comes from the term plan, where margins are anywhere between 50 to 70%, that is there. So therefore, their blended margins rise to about 25 to 30%. LIC's protection plan is at about just 1%. The management has promised that they will grow this protection plan to 10% over the next 2 years, and from there on, eventually to 25%, that is there. It is not too hard for the company to sell these plans, because the distribution network of the company is very, very strong, that is there. It just has to push these policies that are there to the distributors that are there. The only key challenge remains that these policies are far less profitable even for distributors. However, LIC must educate the distributors that it is profitable for the company. That's why side by side, they must sell this policy also. In my view, I have seen the insurance sector for the last 10 years. It will not be difficult for the LIC brand to sell term plan, because the brand, the reach, it is unparalleled, and no other company has that unparalleled reach that is there. So if the company really wants to change, it will change. And I really hope, and I am really expecting the company to change over the next 2.5, 3 years.
And a term plan essentially makes a lot of sense from the perspective of the buyer as well. But that's a conversation, I think, from for another day. One of the arguments that is being made, and I think you alluded to this also, is that LIC has come to the rescue of a few entities, right? So if you were to talk about the acquisition of stake in IDBI Bank, this was a bank that was not doing particularly well, and it has a few assets. So capital has been employed in certain directions which maybe a traditional life insurance company would not do. Is that something of a concern going forward, or do you think that now that this company is getting listed, there will be checks and balances going forward?
Alex, first of all, we must congratulate the government that is there, that they have done a fantastic job in listing such a big company that is there. Second of all, we must appreciate that the government of this country does have some social responsibilities that are there, be it in business or be it for people that is there. We, for one, do not expect LIC's role as a lender of last resort to change. However, given the 45 lakh crores of AUM, the money that LIC deployed was pennies for them, and we expect LIC to continue in this role. However, if the business changes, the market will negate all of these factors and concentrate on the fantastic profitability of the business that is there. If the business does not change over the next 3 years, the market will start to concentrate on all the wrongs that are there with LIC. So the base case assumption continues to remain. It will continue to remain lender of the last resort that is there. However, we will negate this if good business prospects turn into reality. If not, it's a problem.
Laid that roadmap out. With that in mind, and you've already stressed that, or you've indicated what the approach that the retail investor should have. But I'm coming to the most important point, and this is something that all my viewers are going to pay very close attention to, Aditya. It's quite likely, and we're talking at a time when the subscription for the IPO is nearly 100%. It's possible that people who apply for allocation or try to buy into this IPO won't get allocation. There are some people who are looking for listing gains. Is that a wrong strategy? And those that don't get allocation, should they look to nibble in after the listing is taking place? If the value rises too substantially, does it still make sense to buy in at that time, or do they wait for the dust to settle?
See, the size of this IPO is humongous, 20,000 crore IPO that is there. So in such big sizes of IPO, the gray market premium, which is not recommended by SEBI, but still it will die down as the IPO progresses. So in my view, you should not be applying in this IPO for any listing gains that is there. Only long-term investors who are seriously wanting to get exposure to life insurance sector, they should invest. Point number one. Point number two is you can have 1 or 2% allocation of your portfolio inside this company that is there. Only when the company gives indication of trying to change their business model, you should start to increase the allocation that is there. For those investors who do not get allocation, you have to wait and watch how the stock gets listed. If the stock falls below the IPO price that is there, it is a fantastic buy that is there. If the stock rises to about 1500 and the embedded value goes to about 1.5 to 2 times that is there, again, you have to wait and see the turnaround prospects of the company that is there. So my overall advice to retail investors will be buy slowly and steadily. Do not go overboard that is there. There is a huge chunk of 1 lakh crore of disinvestment that will come up in the company over the next 1.5 years that is there. And if the business prospects do not change from here on, you will find that the stock may trade lower because of the huge supply that is there. So be cautious, be a long-term investor, invest little bit that is there, and look at the prospects. For the short term, do not speculate and do not go into the gray market premium business because markets are volatile and anything can happen.
On that lovely piece of advice, I think we have covered all of the bases. Thanks to you, Aditya. And I'm glad that you've been able to speak to us. Pleasure speaking with you.
Thank you.